Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today is Monday, December 14, 2009. We begin today's broadcast with a look at the Tankan survey from Japan, which measures the sentiment among large manufacturers and large non-manufacturers. The index showed improvement as the headline figure for the manufacturing index rose 9 points to negative 24 in the fourth quarter. That 9-point rise was the smallest increase since the economy emerged from recession, but it did beat forecasts. A negative number here means that more managers answering the survey are pessimistic compared to optimistic. The report showed that Japanese large manufacturers continue to plan deep spending cuts in order to protect earnings they see are being eroded by a strong yen, which rose to a 14-year high against the greenback last month. Large companies in the report plan to cut spending by 13.8% in the year ending March 2010, which was the second worst projection on record. If these companies are going to be cutting their capital spending, it will mean fewer jobs and perhaps closing of factories. Also from the report, something to note is that there's a big gap between small businesses and large ones, as the index of sentiment at small manufacturers will worsen to minus 42 in March from December's minus 40. Those figures aren't shown here on this slide. If we look at the dollar-yen pair, we see that to start the week, the pair fell in favor of the yen, as the Tankan survey was taken to be more of a disappointing report, as it showed that capital spending was going to be scaled back in the first quarter, and we saw small businesses faring poorly in the report. However, following a test of the 88.30 and even the 88.40 level, we found some support. This line here has been alternating between support and resistance going back to around the late November. Here it had acted as support, was broken, then acted as resistance, and you see that its role has been changing throughout the past month. Currently it is acting as support here. Also, the fall here in the dollar-yen pair was a retracement of about 50% between the 50 and 61.8% levels. So we tested the 61.8% level as our low for today, and currently we're consolidating around the 50% level. One development to keep an eye on is that the yen has the potential to replace the dollar as the top funding currency for carry trade again, as borrowing from Japan became almost as cheap as US loans for the first time in 4 months. With Japan currently battling deflation, the central bank can't cut off its monetary spigots, so chance that the yen weakens if risk appetite rebounds on recovery news is strong. However, for that scenario to play out, volatility in yen pairs would need to decrease somewhat, as high volatility has the chance to take away from gains in carry trade. In a look at some fundamental news that had an effect on investor sentiment, we had 3 major stories. First, we had Abu Dhabi saying that it will give $10 billion in financing to Dubai in order for it to pay back a portion of its debt. So that was helpful to risk appetite. We also had Citigroup saying that it would repay $20 billion in TARP funds. And Exxon said that it would buy a domestic oil and gas player, XTO Energy. So all 3 of those show positive signs for risk appetite, and in New York trading we did see US stocks gaining, which helped some higher yielders that we will get to soon. In a look at the pound dollar pair, we see that we remain in a bit of sideways trading, but that the reaction to the Abu Dhabi and the $10 billion that it was going to give to Dubai helped give the pound some strength in overnight trading. That rally there in the span of an hour or so amounted to about 130 pips. However, we did run up against this downward sloping resistance trend line, and the pair paired some of its earlier gains, finding support around 1.62, and then in New York trading we saw the pound rallying again on risk appetite. So here we can set up upward sloping support line, and we see that we are converging, which is a sign of consolidation, and we'll see if we move above either of these levels in today's session or in the coming sessions this week. The Aussie-US dollar pair, which was weaker on Friday and extended those declines at the start of Sunday trading, found support at the 0.9050 level and rallied back to trade around 0.91, where it paused, and then rose again in New York trading as risk appetite benefited from higher stocks. That rally ran up against a downward sloping resistance level here around the 0.9170 area, and that stalled the rally. So this pair remains confined within the ranging trading we had seen last week, with support around 0.9020 and resistance level here, clearest resistance level here at 0.9185. The US dollar Canadian dollar pair rose overnight in favor of the greenback, extending the gains from Friday, but after reaching resistance here, which lined up rather nicely to our highs from last week, the pair stalled its rally, and the Canadian dollar was able to pair all of its earlier losses, moving back to its low for the session around 1.0570 by around 1 p.m. Eastern. This pair, if we zoom it out, seeing a bit of an ascending triangle pattern here, as we have a resistance setting up at a horizontal level around 1.0660, while we have an upward sloping line of support. So that's our recap of today's session. Let's see what upcoming releases we have in store for tomorrow's session. Tonight, UK will post another measure of house prices, the RICS house price balance, while Australia will post data on housing starts and post its RBA meeting minutes. Overnight, Switzerland releases its industrial production, while the UK will post consumer prices and the DCLG house price index. Finally, overnight, Germany and the Eurozone will be posting their ZEW economic sentiment index. Tomorrow, the US releases data on producer prices, its Empire Manufacturing Index, and its measure of industrial production, along with the NAHB Housing Market Index. Canada, meanwhile, will post its leading indicators. And that'll do it for today's daily video recap. For more news, videos, and analysis, please visit our site, fxtimes.com. I want to thank you for watching, and happy trading. The euro-dollar pair had a general rise in today's session, following our slide to support around 1.46 area in Friday's trading, following a break of this upward sloping support line on better U.S. retail sales data. Today, we saw this move up higher in the euro, following the announcement that Abu Dhabi was going to give a last-minute bailout to Dubai World to service a $3.5 billion bond payment due in today's session. And following a correction to that rally, we're having a second leg. Now we hit resistance here, which was close to our low from last week. So that could mean that this level of support has now turned to resistance. We had two releases come out from the Eurozone, and they were both rather disappointing. We had the preliminary version of October's industrial production, and we saw output decline by 0.6%, which was forecast. That left the annual rate down 11.1%. Output of non-durable consumer goods dropped 1.6% in the month, following a 0.7 rise in September, and production of durable consumer goods fell 1.4%. A second report showed that employment for the third quarter declined 0.5%, which followed a 0.5% decline in the second quarter. So those two indicators show the headwinds facing the Eurozone economy as it emerges from its recession. The high value of the euro can hurt exports, while rising unemployment will cut into consumer spending. So that'll have an impact on industrial production, as we saw. And we'll see if the job cuts that companies have undertaken in order to cut costs continue as we move into 2010. Currently, the unemployment rate in the Eurozone is 9.8%, which is the highest since December of 1998. Finally, in the UK, we had the Rightmove House Price Index come out, and it showed a 2.2% monthly drop in housing prices in December. But that was mainly expected, as in the winter, housing prices usually fall. So on the year, housing prices were up 1.7%, which was a very slight improvement from the November period.